What do you make of what we've seen in the sell-off so far from the global markets now kind of bleeding into the U.S. markets?
Yeah, it's painful. I think there's a lot being absorbed that happened over the weekend between Berkshire cutting Apple. You had the Japan sell-off, which, they had to react to our unemployment rate. You have the yen spiking, the end of that carry trade. You have a lot of bad news getting priced in this morning. Obviously, it's something we're watching, but right now, as we talked about before, it's a bend not break. This is a pullback, a correction. We'll probably hit oversold at some point rather quickly at these levels, but it has happened before. If you look back in the fall, actually it started end of July, also in 2023. Between July and October, the markets pulled back about 10% before recovering. It's good to know your long-term trends are still intact. It's just a lot of bad news getting absorbed, not as many catalysts. I do think it's a little bit overblown. I don't think we're going to see a Fed emergency meeting. Remember, the Fed cares a lot less about what's happening in the stock markets than they do about the economy. They're not here to make your 401k portfolio look better. So I think some of this is so much panic after we were so quiet, so overbought, so great, so record-setting great. All of a sudden, we flipped into panic mode, and panic is never a smart investment strategy. Take a deep breath this morning. It's probably not the end of the world.
All right, Nimrit, coming over to you. Vicky says a lot of this is panic, maybe a bit overblown. How do you view this pullback we've seen in the equity markets? Keep in mind, the NASDAQ officially in correction territory.
I totally agree with Victoria here. On average, since 1980, we see an average intra-year declines in the market about 15%. And as Victoria said, we had 10% last year, 5% earlier in the year. And there is a lot of froth built into the market coming into the second half. So it seems like your normal intra-year decline here.
All right, so you feel like it's a bit normal. Nimrit, I'm going to stick with you. A lot of talk about the economy slowing down just based on that jobs report, but I do want to keep in mind, and I said it earlier, 96% of people still employed, wage growth over 3% year over year. Is that possibly being overblown? The idea that the economy is really slowing down?
The economy is definitely moderating. There's no doubt about that. We had a weak employment number actually in April as well. And then we had a rebound. And again, you're seeing that. We think the economy has been supported by a lot of infrastructure investment. What the investment we've seen with the CHIPS Act, with the Inflation Reduction Act. And also don't forget the $200 billion a year that the Google, Amazon, Meta are spending just on the AI infrastructure build out. So there's a lot of support in the economy. Also, yes, the lower income consumer, the younger consumer has been feeling the pinch, but the wealthier Americans, the older Americans have been benefiting from the interest rate savings that they've been getting and have been keeping the economy afloat here. So, yeah.
Vicky, come back over to you. So Nimrit says it's a moderating economy. Some people think it's slowing. How does that impact that cyclical trade with the idea that we're supposed to get Fed cuts? I'm talking industrials, materials, financials. In your mind, does that change your view on that trade that a lot of people saw as much more attractive with the idea that we're going to get a cut coming up in September?
Sure. All of a sudden, we went from soft landing to hard landing in about 72 hours. So I'm getting a little whipsawed here. But yeah, I mean, the sham rule triggered, that scared some people. Employment, like you pointed out, we still added jobs. So I think, again, some of this is an overreaction panic. It's probably not all horrible and it's probably not all good, but it's hurting. We're going to watch Caterpillar specifically as they are a huge leading indicator. They look like they may come in a little bit soft. That's a bit concerning. And so, yeah, you're seeing some of these more cyclical, some economically exposed, facing a little more headwinds, but we are still on track to grow GDP right now in Q3. We are still on track to have a soft landing. I know all of that's being questioned, so you just have to step back and say, let's just get a little bit more data. But obviously, industrials are getting hit a little bit. Also, financials, there's not a lot. Right. There's just this flight to safe havens, flight to rate sensitive. So I think people, one, need to be careful of where your positioning is, and then two, realize that we are still in a period of economic growth. So some of this needs to be taken with a grain of salt, that it's not like we are contracting at this point.
I'm taking that grain of salt. We're almost out of time. We have to make this quick. Vicky, your pick for us today is Amazon. You say you're buying on the weakness, down 10% since earnings. How attractive is it at this level very quickly?
I like it, but the problem is I think there's more downside to come, so I'm nibbling. I'm not going all in on it. It's something I'm deploying cash over the next 1 to 2 months because I think we still have some downside left.
All right, Nimrit, again, we're almost out of time. Your pick for us, Sprouts Farmers Market. Shares up actually over 100% year to date. Why is this attractive right now with the idea that we're seeing a slowing economy and maybe a weaker consumer?
For long-term investors, Frank, we picked this because it's a nice reminder how important it is to be diversified. This is a small cap name, 400 stores, regional grocer, continues to grow, has very
Right.
nice earnings because they're offering value to the customers.